Hi, I believe that we're live here with our next panel. I hope that everyone was able to log in okay. The next panel is entitled The Market Update, State of the Market with NAIC and LIBOR Transition. And this panel will discuss the year's private placement market activity from a business perspective, as well as the current state of LIBOR transition and what's going on with the NAIC and their focus and impact on certain asset classes and privately rated securities, as well as certain trending changes in documentation. The moderator of this panel is Chip Fisher. Chip is a partner at Aiken Gump. He likely needs no introduction for most of you. He's been working representing institutional investors for over 35 years in our industry, has been a very active member of the ACIC, as well as a former trustee and counsel to the PPIA. With that, I will hand it over to Chip.
Thanks, Patty. Hi, everybody. For those of you who have had audio issues, I sympathize. Mine got resolved about 15 minutes ago when I was in a full state of panic, figuring I would not be able to be on this panel, but it got resolved. A few introductory notes. You can ask questions through the chat application. Subject to time constraints, the panelists will answer questions at the end of each presentation. We'll give out the CLE codes during the course of the presentation. And as you know, the presentations are available on the Attendify app. You should fill out your CLE affirmations and send them back to the ACIC by next Monday, I think it is. And there will be polling questions during the course of the presentation. And we hope you'll take the time to answer those. So to introduce the panelists, we have Mark Williams. He's the guy with all the books behind him. He's of Bank of America. I don't think he needs any introduction to this audience since he's been doing privates longer than I suspect he'd like to remember. Sasha Camper is next. She will give us a regulatory update. She is with American Equity and has been the point person for the PPIA, the Private Placement Investors Association, the business equivalent of the ACIC. But she's been leading the charge on regulatory matters for the PPIA. David Wagner is next. He's the guy with all the frames behind him. He'll talk about LIBOR transition, which he's been actively involved in. David is with Houlihan Lokey. For those of you who have done workouts, you almost undoubtedly run into his firm. And then, assuming we have time, I'll finish up with a few document points. So with that, let's get started with Mark's presentation. Mark?
Okay, that's great. Well, first, I just want to start by thanking all of you for having me here today. This is obviously a little bit different than what I anticipated when I initially signed up to be a part of the panel. I think at the time, things like virtual meetings and Zoom chats and this thing called Attendify, they all felt pretty abstract to me. But now they appear as sort of customary and normal. And Chip pointed out the books. I don't really read those. They're for show. They're in the back, but just to give me a better background. But I wanted to spend my time giving you all a sense for the overall health of our market. And if we could go to page 1, CJ. So I think if you were to look at the highlights for 2020 year to date, I think you'd see a few things. The first one, and this would be a surprise to many people, is just the overall pace of issuance here in 2020. I think not many of us, if we were asked back in March to predict what 2020 would look like as we started to look into the pandemic, I don't think many of us would have imagined that the level of issuance that we've seen so far would be the case. If you go back over the last 3 years or so, our market's been hovering right around 75 billion in issuance. And that's a far cry from what it was before that. If some of us probably remember, and Chip alluded to this, in the early 2000s and sort of late 90s, the 30 to $40 billion a year was a pretty big deal. Post the global financial crisis, we started creeping up into the $50 billion range. And then it really took off in 2017. So if you look at where we are year to date, we're already eclipsing 2019's numbers in terms of both dollar volume as well as deal count. It's not a stretch for any of us to think that this could be one of our largest, if not the largest year ever. And then despite that, the investor demand, what's come in from your side, has significantly outpaced issuance levels. So cash really remains unspoken for and off to the sidelines. I think the other thing that I would really kind of focus on, if you dig a little bit deeper, is just the complexion of the deals that have been done. We've seen a nice combination of both new and repeat issuers. We've seen some truly massive transactions. 5 this year already have been over $1 billion. One of them at $3 billion is the largest transaction we've ever seen in our market. If you were to kind of exclude some of those mega deals, however, I think the average deal size has gone down a bit. Chip and I were kind of talking about that. I think it's an interesting fact, but maybe 2 things I'd point to. It's hard to put too much stock into those numbers. Once you pull the big deals out of that number, I think they really have gotten larger. But on the other hand, we've seen quite a few financings early on with COVID that were viewed as filling short-term needs. 25 million here for liquidity, 50 million there, general corporate purposes, but just different than your typical financings. But we like to look at all these statistics because it becomes, pretty easy for us to kind of fantasize and wonder how large the market can actually grow to. Now, if we could turn to page 2. Here we dig a little bit deeper still and kind of take a look at some of the monthly volumes. The dark blue bars, they represent dollars done in billions. The red line gives you a sense for the number of deals that we've done over the course of the year. Both are there sort of numerically as well. In some sense, I think this monthly chart, it does follow some of the fairly well-established patterns in our market. And I say that with maybe one key difference, and that is virtually everyone that we've talked to has worked hard and kind of pushed through the summer when normally there's a break. And, that part's, I'm sure it's not a surprise to this group because you've all been doing that work. But we've all been extremely busy since things came under pressure in March, April, May, June. If you look at those, things really wrapped up in those months. And then you get to July and it's that tall tree out there. It was the single busiest month on record in the private placement market at more than $10.4 billion. So I think if anything, sort of travel and vacations over the summer, that they took a backseat to deals. But that was really true in most of the high grade markets. If you looked at the public market as an example, they've set all types of records for flow monthly, sort of weekly, annually. And that would be, I'd say, true for the capital markets on the whole. If we could move to page 3. We have here a breakdown of the market by sector and geography. If you look at the left-hand side here, we've got a pie chart of the various sectors that we at Bank of America look at, how we group things. And I would tell you, it looks a little bit more diversified than what you would have seen historically. So things like utilities, energy, general industrial credits, they've always been a big part of what we do. But this year, if you were to focus on sectors like real estate, and that's probably the last 2 or 3 years there with REITs being very prevalent in our market. But you look at real estate at 16%, sports, it's at 8%. I would just note this is the single largest year ever in sports issuance. It's been a huge part of our market despite some of the COVID concerns. And then financials at 12%. Those have all really picked up their issuance levels. So the chart itself looks a little bit different. As I look over on the right-hand side of the page, we've got a breakdown by geography. U.S. issuance is almost 70% of the market. That's based on dollar volumes. Actually, both charts are based on dollar volumes. Europe represents 18.5%, Australia and New Zealand 7.5%, Canada at 3%, and 1.4% everywhere else. But this is, from our standpoint, a pretty remarkable shift where if you were to look at your typical year, the percentage of U.S. transactions is somewhere in the 50s, so 50 to 58, 59%. It's a lot higher right now. And it's another one of those considerations. We'll keep talking about this as we try to answer the question of how large the actual market can grow to be. And I think that leads us to our first question for the group. Down there in the bottom in the red, how many of your institutions have worked on transactions out of Latin America this year? I think it's posed as a yes or no question. Yes if you have, no if you haven't. And I think you'll see that in just a second. if we could move to page 4.
Hey, Mark, maybe hold up just a second. I think CJ is going to tabulate the responses.
Oh, okay, even better.
Yeah.
Yeah, sorry about that.
Take your time.
We had 67% with no and 33% yes.
So I would say just at first blush, that's not a surprise, but it's interesting because one of the things we've talked about, and we do this, in theory down in Miami at conferences in January, but we talk about, other jurisdictions that, have you done the work on it? Have you looked at it from a research or a legal perspective? Are you comfortable in these various jurisdictions? Because that's just another way for us to kind of grow the market. So not a surprise, but thank you for that, CJ. On page 4, one of the things, I think we focus on, or at least we pay attention to, is a breakdown of the issuance levels by credit quality. Here we show sort of 2 metrics. First on the left, we've got NAIC 1 versus NAIC 2 issuance. You'll notice a fairly significant shift towards quality, not a surprise, 2019 to 2020 on a year-to-date basis. And that's, again, based on dollar volume. But that's really driven by market access. I think if you can imagine, this is completely expected. The NAIC 1 issuers have had far greater access to capital during the pandemic, to the tune of more than half the deals that we've done have been viewed as NAIC 1s. On the right-hand side here, we've got issuance by rating, and we do that both on a dollar volume and a deal count basis. Similar response, but again, a fairly large move towards rated transactions by either metric. We're looking at more than 2/3 of the deals having 1 or more ratings. Market access is a piece of that. The other piece is really just the tendency by those issuers needing the capital to be rated. So as we've talked about how that pie chart's moved a little bit, if you take into account things like utilities, sports-related transactions, they almost always have third-party ratings, which has started to skew those numbers a bit. We can move on to page 5, CJ. So here we have transaction sort of types, and we've got the 4 or 5 buckets that we typically group things into. The first is refinancing, then general corporate purposes. We've got CapEx, and then M&A and dividend related. We kind of group those together given their size. What you would find here is probably as expected. I would say refinancing, for as long as I've been doing this, it's almost always been the #1 use for proceeds. Those are your typical leverage neutral transactions. And if you look at the movement from 2019 to 20, it's been pretty small. Refinancing needs, they tend not to change dramatically. You kind of know what you borrowed and what comes due and what has to be refinanced. They do change when you see a move towards capitalizing on a favorable rate environment. And you see some of that now. General corporate purposes, it's made a fairly large move, really almost tripling in size. I think we all view this as smart and sensible corporate finance. Issuers are looking to ensure they've got sufficient liquidity to get through the pandemic. And that's one of those, win-wins from the investor's perspective as well as the issuer's perspective. And then I think the final 3, CapEx, M&A, and dividend activity, they total just over 10% of the volume. And again, one of the factors we look at when we talk about how do you get to a larger overall private placement market. I think we're all waiting to see more on the CapEx and M&A side as real growth drivers of what we do. If we could switch to page 6, we'll continue to talk about some of those capabilities that we really look to kind of serve to expand our market as a whole. As agents, that's something we focus on when we're talking to issuers. What can we do that's different that will bring people to our market, which provides more opportunities for you all to put capital to work. I think one of the real success stories on the private placement side is the non-USD issuance. It's served to fill a real need for issuers to the point that over 16% by dollar volume and more than really 1 in 4 transactions has a non-USD tranche of some sort. I think most of the investors who provide non-USD funding, they do so through cross-currency swaps. Some have it naturally, but as a result, the number of currencies that are on offer can be significant. And you can look at the bottom left-hand side. We've got a chart that just shows you the evolution of some of the more common currencies, but I would also tell you that in the last year or two, we've done some pretty out there ones as well. I think the one thing that surprises me and remains surprising from my perspective is how long some of these swap transactions have actually gone. And they've gone out to 25, 30 plus years, which I would say 5 years ago, I just wouldn't have imagined that, candidly. If you look at the number of investors who've got those capabilities, it's more than 30 today. And there are quite a few others who are working on it, which kind of leads us to our next question. At your individual institutions, how many cross-currency deals have you worked on this year? Is it 1 to 5, 6 to 10, 11 to 15, or greater than 15? And that's multiple choice. We'll pause for a second. I think if CJ if anything comes back there.
Can you hear me?
Yes.
Okay. We've had nobody vote on this poll.
Okay, so let's address that one later on.
Okay.
That's not a problem at all. So I'm going to be a little bit mindful of our time. I'll go through these next 2 or 3 pages fairly quickly, and then get to the kind of the capstone slides at the end. But here on page 7, we've got the beginnings of really, in essence, what every issuer or prospective issuer is studying right now. You've got a record low interest rate environment. Specifically what's happened over the last 9 months of, I guess the first 9 months of 2020 in the midst of a pandemic and what's been a sustained stimulus effort. You look at the far left, we've got our pre-COVID graph. 192 area, still historically speaking on a relative value, it's historically low. But then you look at to the right, what's happened sort of post-COVID. In 2020, that 10 years declined as much as 141 basis points, setting an all-time low of 51 basis points as the Treasury yield for a 10-year. That was on August 4th of this year. Historically low Treasury environment. If we could move to page 8. We'll talk about, I guess, the other half of the kind of coupon equation that issuers are paying attention to here on page 8. We take the 10-year Treasury rate graph from the prior page and juxtapose that against the U.S. corporate spread index. And what it does is it demonstrates what we think is a pretty powerful combination of both historically low Treasury rates as well as extremely attractive spreads. And those have come in a bit as we work through the summer, but they're still very attractive. And that leads us to the bottom chart, which is just a graph of sort of all-in investment grade corporate public market yields or coupons. That's Treasuries plus spreads, which again just really represents extremely attractive financing levels and hence the increased corporate activity. We could move to page 9. We'll try to bring this home a little bit more. Page 8's really about the public markets. It's relevant in concept, I think. Certainly not exactly the same as our market. If you look at page 9, we've got a bit more color on the private placement side. These charts themselves, they go back quarterly for the last 2 years. Got to count that quickly. The left-hand side is for the NAIC 1 credits, right is for NAIC 2s. And the upper half of those charts really just show kind of a range of high and low levels for spreads, as well as that average spread there in the middle. It's highlighted in the shaded boxes. It's a sometimes, I'd say at times, large differential, and really no surprise to you all, it's driven by sector more than anything else. A financial might trade dramatically wider than a utility, for example, and that's been even more pronounced during COVID. So you see that in those 3 quarters. Down below, we just compare the average private spreads to the relevant public counterparts. We talk about this with issuers a lot as we're sort of talking about new transactions. Spreads in our market have always had a tendency to lag public spreads. That's been the case for as long as I've been doing privates. And these graphs just give you at least a partial sense for that. And while in our header, we do note the, I think we say dramatic tightening in private credit spreads, we're still always a bit behind the public market, but we seem to be catching up now, as you can see there. On to page 10, if we could, CJ. So what has all this meant to the private placement market as a whole? Let's kind of talk about or look at how it's functioned. I think we've talked about deal flow. It's been really busy. The market itself, it's active, it's pursuing deals. Some industries have had better access than others, but the overall sort of flow of transactions is up. Deal flow is actually up. When you look at amendment and waiver activity here, that's also increased. No surprise. For most of us, I don't think we can imagine a more, I guess, a busier time on the amendment front. And I'm watching Sasha shake her head and nod. And yes, I think this has been as bad as it's been. It started in April, in May, and I think at that time, the most severely impacted sectors, aerospace, retail, food and beverage, food service, those came fast and furiously. They were really put a strain on our system. And I think the routine response and the feedback we heard from investors and analysts on the business side, whenever we called with a new amendment, we just heard how inundated they were with requests. I think many have told us over the months we've been working on 20 or 25 or more amendments at one time, which has just been a brutal pace. And I'm talking to the legal side. I can imagine that this group has had it even worse. So that part has been something that's not lost on any of us. There was a brief lull midsummer, but then towards the end of the summer, the next wave hit. And those were from issuers who, after the initial disruptions to their businesses, they were able to step back and better assess what the pandemic was doing to their business prospects longer term. I'll give you my personal view. I think our markets, it's risen to the occasion and performed very well. As always, there's a horror story or two, but that's not to be unexpected. The vast majority of the deals we've worked on and things we've seen, I think we've been constructive. And I think the sentiment that we've heard from your business counterparts has been pretty simple, which is for those credits who are performing well pre-pandemic and are now struggling, and it's through no fault of their own, nothing they've done wrong, simply because of what's happening in the world. For those credits, our market has been incredibly supportive. I think we've kind of developed a playbook of sorts on amendments. It's temporary waivers. We're not trying to reset covenant levels. It's liquidity requirements, making sure we've got adequate liquidity to get through. And then coupon bumps, in only the most extreme cases, those have come into play as well. But you've been constructive. And I think, on the other hand, those issuers who've got kind of nice to have requests, the process understandably has been more challenging. And that's just something we have to work on continually. The universal theme, and I'd say this is true in almost every case, is the timeline on amendments and frankly, new deals as well. It's just increased a little bit. Page 11, which is my last page. Again, so, what are we seeing here? In my mind, I think our industry, we're a resilient group. And I think we're a resilient people in general, but kind of mentioned this at the beginning of the talk. We're all in a slightly different place than we would have imagined going into this. I think at the end of the day, despite the interruption and the headaches that come from working at home, I believe there's actually a session on this as I was looking through the agenda that happens right after this one. I think as a market, we've still managed to process deals and do new business. It's different, but it's getting done. Technology has played a role. It'll play a bigger role. I'm not sure when any of us will be, hopping on a plane and doing roadshow meetings or in-person meetings with clients or issuers. We've moved to conference calls and Zoom calls and any of a number of other platforms. And while I think those are, they can be tiresome, I think spending your whole day on Zoom is a challenge. But we've been able to get through it. They do work. I think some elements of this current setup, I imagine they're going to remain in place once we get back to something that's closer to normal. A lot of you probably been told you're not going to be back in the office until 2021, and when in 21 is a complete unknown. I think we're in the same boat, and we're all just adapting. And I think maybe the final bit of good news from my perspective is there at the bottom, that while most of the challenging sectors, if you look at how they were being supported initially in terms of new capital, it was in the bank market. There's been an expanding group of investors who've been able to kind of look through and take a longer term approach and start to provide some of the funding there as well. So, I'll end my little bit here by just saying I remain extremely optimistic going forward. And one of the things I focus on, and I can't wait to see, is how large the market, with the help of all of you all, can grow to be at some point down the road.
Thanks, Mark. CJ, I'm not sure I saw any questions. Did you see any?
I did not see any questions.
Okay. Well, just before Sasha gets started, let me give everyone the first course code, which is 46872. To repeat, it's 46872.
Hey, Chip, I
Okay.
do have one question. I'm sorry. For Mark. To what do you attribute the higher U.S. volume as a percentage compared to cross-border volume?
So the big question is, can you still hear me? I tried to go on mute.
Yes.
If
yes.
I get shut down in the middle, that's why. It's the technology. But I think the biggest thing is just the nature of the issuers. I think if you go over and look in Europe and how supportive banks were there, there's a lot of bilateral relationships going on there. And as people look to short-term needs, those banks stepped up and fulfilled them pretty readily. So I think that's been the biggest driver.
And
Okay.
that's all I see. Thank you.
All right. We're on to Sasha then. Sasha, the regulatory update. Sasha, can you hear me?
Sasha is having some issues with her microphone.
Okay.
Sasha, did you try to go in and out of session? And if not,
Well, David, you may not have been expecting to be second up to bat, but in the circumstances, that may be what we have to do. And then Sasha, if you can hear me, see what you can do to get your audio back. Yeah. Sasha, you're muted. Did you take your mute off?
I recommend going in and out of session and then coming back in. And then checking your where your mic is, like we did yesterday.
It looks like she's frozen.
In the interim, while she's doing that, I suggest we move on to David.
Yeah. David, can you hear me okay? David, can you hear me? Oh dear. Mark, you can hear me okay, yes? Mark?
David, if you're frozen, if you can go in and out of session also and try. Is David on screen?
David, looks to me like you're on mute. Can you go off mute if you can hear me?
Is David still on? Is David on mute? I'm gonna stop sharing my screen for just a second. Is everyone frozen?
I think Mark and I are fine, I think.
No, Mark is frozen too. I think everyone needs to leave session and come back. Well, they need to leave session and come back. And then try and so that way they won't be frozen. Just like we talked about, and test if they can leave their session and come back. I'm going to email them right now.
All right.
Hold on one second. Little technical difficulties, everyone. Just bear with us for just 1 second. Um, um, and Mark. Okay. Otherwise, Chip, you're doing a great job today. Thank you.
Yeah, I've frozen out my entire panel.
You froze out everyone.
Yeah.
You're doing such a great job. You froze everyone out. Okay, I just sent them an email asking them to leave session and come back in. So hopefully they will get my email and they
Okay.
will do so. Fingers crossed they're checking their emails. I promise everyone we went through test sessions and did this and it worked just fine.
No, I can confirm we did a practice session and it worked fine.
And if for some reason we can't get this to work, what we will do is we will go ahead and we will record this later and we will put this back up for at a later date.
Well,
So
I suppose if I'm unfrozen, I was going to only fill in at the end if we had time. I suppose I could talk about my stuff now while we wait.
I can fast forward to your slides if you want to do that. But hold on 1 second.
Yeah, I think. Yeah, we might as well do that much.
You got it, my friend. Hold on 1 second. Let me get back. Let me get to your slides. There we go.
All right. Well, then I will go forward with the few document-related comments that I had. To begin with, the make-whole amount holiday. As I imagine a number of you have seen in the last year or two, there have been deals where the drafts provide for no make-whole amount being payable if the notes are paid early near the end of their maturity. The period during which this make-whole holiday applies, at least what I've seen, has been 3 to 6 months, depending on how long the original maturity of the notes was. I wanted to ask Mark about this because what I have been told about this is the make-whole holiday just makes life administratively easier for issues. They don't have to match up maturing notes with refinancings and calculate some small make-whole. I don't know that I buy that, but that's what I've heard. I will say that one deal we had recently, the whole concept of a make-whole amount morphed. And maybe if we go to the next slide. There we go. This one, if you look at the bold-faced language towards the bottom of the first bullet point, you will see there's an assumption. And what that assumption was is that if there is a prepayment of the notes at any time while they are outstanding, including.
Oh God, is he frozen? Is he frozen? Okay, it appears that everyone is frozen. So what we're going to do is we're going to re-record the session at a later date, and I apologize for this. And what we will do is have the session available for your viewing at a later date, which I will post when it is available, and you'll be able to obtain your CLE credits for a later date. The next session will be at let's see, 3 or 4 o'clock Eastern Standard Time. And we will have everything up and running by then. And I apologize again, and we will get everything up and running.